All right. Well, I'm very excited. Welcome, 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 everybody who's made the commitment and the effort to be here for a live session of wedges as we continue our wedge education. I really am pretty excited about wedges. Over the years, I've traded different chart patterns just when they showed up. I really wasn't looking to find them. They just would be there, little flags, little pennants, big runs and tiny retraces, and you could tell it was a little flag or pennant and high percentage move to the next high or low. Um, but in the last 2 years or so, I got reintroduced to wedges at a higher level through various alert services, and it really, I'm like, okay, this is kind of an interesting concept. And I started looking at it, and I realized how simple wedges are to trade. There's a very um, practical way to trade them and a very simple reality that is very high percentage with wedges that in my own trading and that those that I've worked with closely have been able to duplicate very high percentages and do some pretty incredible things without a lot of tenure in the trading world required. And so that makes it something that's pretty interesting for newer traders and intermediate traders that are looking for a level of consistency. And so, um, I delved deeper into my understanding of what wedges were, how to trade them, and it made a real nice marriage with a technology called harmonic wave convergence, which we're going to get into down the road in terms of wedges. And even simple efforts with harmonic wave convergence, when combined with wedges, leads to incredible things, including being able to enter the wedge break before it breaks and being able to extend the wedge run when you are in profit. And most importantly, when you're in a wedge that isn't going to succeed, it allows you to get out of the wedge most of the time without losing. And that's a pretty cool reality. So let's go ahead and get started. Now, some of you who've been with me for a while have seen some of my various wedge training, and so a lot of this, at least at the foundational level, is going to be repetitive. Um, don't say, oh, I've seen that already. This is part of what is important in the repetition in building your subconscious's understanding of what wedges are so you can eventually move to a subconscious state of flow as you trade wedges, and things are just recognized through your RAS mechanism, which we've talked about briefly. All right. So always have to start out with a disclaimer, and I'll do the short form in the red box. Trading Forex is very risky. Results are not guaranteed. Your results may and or will vary. Only trade with money which you can afford to lose. Past performance is not indicative of future results, and this is not a solicitation to invest. There's a little intermediate explanation on the right, and in the bottom right of the disclaimer, you can see for complete disclosure on the risks associated with trading, please visit www.tradingdisclaimers.com. There's a couple pages worth of disclaimers there that talk about the potential for profit as well as the potential for loss. And literally, in the end, you, the trader, are responsible for your choices and decisions in regards to trades. All right, so wedges are a pretty great fit for what I historically have done pretty much the last 10 years of my trading out of the 17 plus I've been trading, and that is trading in the new paradigm versus the old paradigm. So, the old paradigm is exactly what's taught today to 95 to 98% of most traders. There's some that are given hybrids, but for the most part, almost all traders are exposed to the old paradigm. And it's so interesting once you understand what how that paradigm is defined, and you start trading and becoming active in the new paradigm, you'll see how it earns its name paradigm. People just don't understand or literally believe in anything outside of that because that's all they know. And so you will see too trading industry celebrities and gurus, say certain things which as you get stronger in the new paradigm, you'll understand how their knowledge is limited. Now, I'm not saying they can't be good traders in their own right, because many people have invested literally thousands and thousands of hours in their efforts. And so some can make the old paradigm work. It usually requires a high degree of capitalization. So it's a little asterisk there on those that are successful in the old paradigm. And that's principally because the returns are so small, even on decent sized trades, because of the way risk has to be managed, the way the old paradigm systems are taught. So the old paradigm pretty much has lagging indicators, which means you have big slush in your moves. Everything has to be scaled up. In other words, every time frame you move up, you have to add an extra factor of 5 to 10 in your stop losses. So by the time you're a swing trader on 4 hour charts, the industry standard is about 150 pip stop loss. Some are less, some are more, but that's it. So it continues to scale up in size as you move up. You have bigger stops or bigger covers because the moves and the waves are bigger at larger time frames. Because of the stops being bigger, you have a low return on account per pip gain, which is really the only true measure of trader profitability. It's not pips, it's not dollars, it's your actual return on investment per pip gain. And the way that gets increased is by having a way that you can trade technically and successfully with smaller stop losses, as we'll learn. Um, it's a tougher psychological road. For the most part, what I've seen over the years is that systems in the old paradigm actually fight against your ability to learn and grow from a psychological, emotional standpoint. It fosters psychological confusion. It fosters a hesitancy in traders, and it's just a mess, literally. It and because it's a harder psychological road, your RAS, your sensory information gateways, are will struggle to be able to help pull the things, screen in what you need to see on the charts and screen out what you don't need to see on the charts. It typically has a pretty significant up and down equity curve. And again, this is why some people can succeed in the old paradigm, and that's because they can withstand the equity curve. That might be a financial reality, that might be a psychological reality, that might be a support structure that they have that allows them to have those months with 25-40% drawdown and then continue to move forward because they're increasing the lows in that equity curve as time moves on. In other words, they have a drawdown, but then they'll recover, and their next drawdown will be at a higher level. So while it is ups and downs, it is at least pointed up. And the only challenge with that is that doesn't happen frequently. Most of the time, those pullbacks are setbacks, not just financially, but then psychologically. The support structure evaporates, dissipates, and now the trader is kind of hanging there, right? So up and down equity curve. Generally, it's a slower growth. I mentioned that because you have to have extreme capitalization in the old paradigm to make those 150 pip stop losses actually bring you some profit. So it's one thing to be a winning trader. It's another to be able to win with smaller capital accounts, which is where most beginner and intermediate traders are sitting. Lastly, trading becomes a chore. It's stressful when you have those intermittent results, inconsistent results, and the psychological burnout. It just it's one of those things. If you go to bed at night and you're not happy because you have to get up in the morning and hit the charts because you're an old paradigm trader, then it's a chore. And so that eventually leads to the failure rate in Forex, or lack of success rate. It's not true that 95% of the traders fail. It's a lot of the failure is absolute quitting. People get burned out. People win, but aren't winning at large enough percentages of return for the time they put in. And so all of that leads to non-success, if you will, but voluntarily leaving because you're burnt out or because you are winning but not making as much gain as what you might have liked, that can't be considered failure. That's a voluntary resignation from your efforts in the marketplace. So it's a little overstated to say 95% fail. It's just not true. Now, in the new paradigm, we're a little bit different. We're a whole lot different, right? We use real time indicators. There's very little slush. Scaling is insignificant. I can move from a 15-minute trade to a 1 hour trade to a 4 hour trade, even to an 8 hour trade. And my scaling of things, such as stop losses, are not that significant to where I can still make tons of money. I'm still going to have the highest return on account per pip gain. And again, return on account per pip gain is really the ultimate measure of a successful trader. Those average trades are going to be 3 times, 5 times, 10 times the profit in the old paradigm, given the same size account, the same downside risk percentage, etc. And that's merely because of the stop loss being so much tighter in the sheer magnitude of the real time indicators that we do use. As a result, the psychological growth is much easier to obtain. What we've seen is the trading actually fosters psychological, emotional growth, and obviously we know that's a requirement. That's the big requirement to be a successful trader. And so to have a trading environment that fosters the growth versus fighting it, like in the old paradigm, it's, your chances of success go way up. Now, look, there's no such thing as guarantees. Every time we talk about profits or potential profits, we have to throw the word potential in front of it. When we talk about being able to make 3, 5, 10 times the profit in the old paradigm, the assumption there is that that trader is profiting in the old paradigm. And in that same trade, because we have a tighter stop loss, we can actually make much better money. All right, you have a faster growth on the sensory information gateway. We kind of control that through very specific models, mostly because we emphasize demo trading in large volumes to create a KSP, knowledge of system performance. That knowledge of system performance is actually what fuels your subconscious mind's ability to trade in flow versus trading mechanically. So if you have post-it notes all around your monitor, do this when, do that when, use this, use that, that's mechanical trading, and it's going to be hard to win because that's conscious trading. You want to be having a lot of the stuff that's seen on the charts become a subconscious reality for you. And you only get there through volume, understanding KSP, and then being able to absorb that and see the absolute reality in your demo trading. And again, I'll emphasize demo trading is for learning what not to do. It's not for winning until you start winning. And then you'll realize you can actually put yourself to a challenge test. Okay, I feel like I've won, or I look at my journal, I can see I'm starting to win trades. Again, you're not trying; it's just happening by default because you're learning what not to do, and you don't repeat the stuff that doesn't work. So eventually, you do have the stuff that does work. If you're jumping all around every 2 weeks to different systems, different strategies, that's going to be really hard. Okay, you're not going to get the volume. You're not going to get the KSP. You're going to continue to trade in a mechanical mode. And that's why inconsistency isn't there, because literally your subconscious mind could perform about 400 times faster, 400,000 times faster than your conscious mind. So you want to get out of doing the things that create a conscious methodology for trading. So in respect to understanding wedges, triangles, and diagonals, all these things are synonymous, at least by name, in the category of wedge. They all have a little bit of different structure, but it's not that relevant once you understand what we're doing. We're going to fully understand risk. We're going to understand what a stop loss really is. We're going to understand how to correctly do position sizing. We're going to do a brief intro to Elliott wave and market structure. We're going to learn to recognize bull and bear trends, and if it's not either, it's probably not time to be looking really hard at a wedge. We're going to learn and understand corrective and continuation patterns, as we've talked about, wedges, triangles, diagonals. We're going to identify wedges, triangles, and diagonals. So identify these things, and we're going to learn beginner trade entry. So that's what we're going to be accomplishing pretty much in the next two, this module and the next module. as we move forward in our wedge trading. And again, we're, this go round in building the library for various educational modules. My goal is to make them smaller chunks. One, so we can have better attendance at the live sessions, knowing, hey, this is only going to last 45, maybe 60 minutes at the longest. And so we may have more modules, but it makes for a better learning environment. And so we've seen this time and time again. And historically, my modules have been pretty lengthy. And while there's immense amounts of information being provided, it's hard to attend a 2.5 hour session on a somewhat regular basis. So these modules, starting with wedges and moving into tridents and advanced Fibonacci and some of the other stuff we're going to be doing over the next few weeks, are designed specifically to be much shorter in presentation. So there will be more of them in the library, but that does allow you to review them faster. That does allow us to diagnose when you have an issue, exactly where to send you, versus saying, oh, it's somewhere in that 2.5 hour module. So modules are going to be shorter by design. Okay. So this one is divided into several modules, and we have just an understanding today of moving forward with risk. And again, many of you know this. We also have many people who are not familiar with understanding risk fully. And we have to do that if we're going to be trading wedges. So some of the stuff on risk truly belongs in a session before this, but I also know what's happening. You have to deal with reality, not just theory, you have to deal with the real world, not just the ideal world, right? So I know traders are going to kind of want to jump into wedges. They become popular. They're going to try and trade live. And so we have to have a foundation here sooner than later that enables them. So some of the stuff that might normally be segregated out to fundamentals of live trading, pieces of them I'm going to bury in some of these modules, just because I know some of the people are going to skip that stuff. So having understand how a trader's trader's mind works, we've kind of gotten a little smarter about where we're going to put pieces of our knowledge base in education. So we kind of hit part of this the other day for those that had access to the bonus section for being early bird signups. We talked a little bit about what it takes to be a successful long-term trader. And I'm just going to review some of that as a highlight. You must have a dream. You must have, and not the why. The why that's presented in pop culture empowerment today is really the what. The why is the passion for the what. So, why do I want, that vacation home? Why do I want that boat? And we got to get past, what the real motivations are, and get past the material side of the objects and get into the passion, the emotion side of the objects. What's the why? Why do I really have that? How do I sense I'm going to feel if I obtain my goal? So you must have a passion for that dream, and it has to be so big, it has to be an inevitability. If it's not an inevitability for you, then obstacles are going to become very big. You must commit to do the work over the long haul. Study, demo trade, engage in our community and our help groups, self-development. You can't skip any of that stuff. And if you're looking for the quick path, the holy grail to overnight financial success, you're probably looking in the wrong place. The cool thing about becoming a trader is it is a skill set that once you have can't be taken away. And as you'll see as we move through our pipeline of knowledge, that what you learn is and can hold and master is readily duplicated into other markets if you so desire. Crypto, precious metals, commodities, stocks, etc. And so having the skill set and understanding the technology, really understanding what's happening with the market is applicable anywhere. You must understand compounding. This is so significant for both the learning side and the financial side, and to understand the true exponential curve and what it really defines and what it's really about. We'll take a micro look at that here in just a minute. You must demo learn what not to do, not to win. And we talk about Johnny. And a term I like are must stakes. the mistakes process. So you have to internalize. Wow, hard getting that one out early in the morning. You must internalize the reality and rename it mistakes instead of mistakes. A mistake kind of explains that the process of becoming successful is learning what not to do. And that means failure. That means losing trades in demo. That means trying a trade and having no fear of taking the trade, because you're not trying. The goal isn't to see if I can win. The goal is to see what can I learn about the process. What doesn't work with this particular thing. Too many people, I often joke with my traders once, I kind of get to know them, that if I were to give you the 50,000 page PDF on trading first day, you'd probably quit. And so to not discourage you, we don't want to give you that PDF. But the reality is, and I don't care where you go for your education, you're going to be taught a principle or a method or a step. And most traders, unfortunately, literally think then that that's it. And rather than looking a little bit to the left and a little bit to the right and a little bit up and a little bit down, and finding the areas that actually define what that item was as it was taught. So we have to be able to absorb what we're taught and then go to the charts and apply it. And that's why volumes of demo trades are important. You won't discover the things that don't work by trying to win in your volume, in your demo trading. By trying to win, you naturally, psychologically, emotionally hesitate. It forces a hesitation. And then you don't learn what doesn't work. My example has always been little Johnny trying to teach him how to play baseball and how to hit a ball. And if you tell him we're going to count how many times you miss, he's going to be hesitant to swing. But if you tell him the only thing I care about is how many times you hit the ball, then he's going to be swinging at a lot of things. He's not afraid of missing. And so you have to understand that mistake process of making failure, of not winning, of going with the flow and experimenting and trying this and trying that a little, will be the key to learning, will be the key to making success. And as Edison is often used as an example, although it's an incorrect one, the example is, him saying, I know 10,000 ways how not to invent the light bulb. Because he just experimented and failed and kept going, learned from his failures, kept his journal, and then learned what not to apply. Now, unfortunately, in the example of Edison, he's the shining example used in pop culture self-development. As most of you may be aware, if you've hung around me now, he never invented the light bulb. He actually bought the patent from 2 Canadian college students. And he's correct when he said 10,000 tries, he couldn't do it. So he bought the patent, and then he enhanced and improved the patent once he knew how it worked. Then he was able to create a better light bulb, but he never really invented it himself. You must have patience, yet act with urgency. Again, in the bonus section, we talked a little bit about a modern day celebrity guru in the empowerment field talking about don't have patience. If you have patience, you'll never get anywhere. And it's just a little bit confused on the difference between patience and urgency. See, patience, literally, when you get down to it, is a state of mind. It's about how you see things, and it has to do with your expectations, which is, again, a danger to create expectations on certain things, because it tells your crew, your subconscious mind, and now your sensory information gateways can work against you as much as they work for you. So patience is a mental thing. It's a psychological thing. Urgency, on the other hand, is a form of how you apply your action. And so they are two different things. So you do have to be patient with yourself, with me, with the systems I teach you, with the Forex in general. But that doesn't mean you can't act with urgency in the efforts that you put forth. You must do the work to grow as a person, not just talk the talk. I'm going to recommend a book here in a few minutes, and the reality is I'll ask a lot of people, if you've read that book. Oh, yeah, I read it. And then I said, do you read it well enough to teach it? And they kind of look at me funny. I said, yeah, I'm going to do a session, and I'm going to have you be the guest speaker, and you teach that book. You teach the contents and the principles and the objectives that were taught. Well, now it's a different story. So it was read, but not totally absorbed, not totally comprehended. And, you know, that's talking the talk when somebody says, "Did you read this book?" And you say, "Yeah, I read it." You know, it's one thing to read it, it's another thing to have acquired the knowledge that's in it. So you have to do the work to grow as a person because I was probably the biggest skeptic, disbeliever, whatever you want to call it, in regards to this when I first started to trade. Uh, I was in a position where what I had done at that point, my achievements, I felt very confident in myself. Not so much arrogant, but definitely confident. And didn't felt I needed to do any more personal growth, and so I didn't. And as a trader, not doing that, not moving forward, because you, as you are, for the most part, unless you're already consistent in your trading profits most of the month, for the most part, then you have to grow as a person. And there's a cool advantage to that, and that is it will benefit all aspects of your life, not just the trading world, because it's hard to compartmentalize growth on a personal side. But it's a huge commitment. It's a huge time effort. And like a recorded video, it could be procrastinated upon because it's something you can do anytime. And things that you can do anytime are readily and heavily procrastinated because something else always comes above it, in front of it, and therefore you put it off. So we have to be careful about that, right? You must understand how your brain works. So when we talk about things like sensory information gateway, when we talk about things like RAS, when we talk about the amygdala being flooded with histamines and enzymes and therefore blocking and short circuiting the function of the RAS and your sensory information gateways, you need to understand that stuff. And we will have full training on all that for the stuff that you haven't already understood or heard about. But you have to understand how your brain works as a trader, because when you get down to the neuroscience of the brain, what we're really talking about and the way we're looking at it is the stuff that affects human behavior and actions. And guess what? For the most part, traders are humans. And so, because it's an anatomical, physiological process, it's the same for each one of us. You can't escape it. You're not going to rewrite, your ability to short circuit the way the human brain and mind works. It's just not going to happen. So rather than having an ego that supports your thinking that you're going to be able to operate differently, or it's not significant to you, or I lived all these years, I didn't know that stuff. Well, guess what? That's why you're here. And so understanding how the brain works, understanding the neuroscience of what causes a human to behave and act is very significant for a trader. And it really, in some realms, it's the thing I believe should always be discussed first. And we will have some heavy emphasis. And when the library is complete over the next couple months, you will see it is the thing that's going to receive significance and importance as one of the first things you want to do. So obviously, we will be attacking this pretty rigorously in the weeks and months ahead. You must conquer ego. Obviously, we're never going to get totally away from it, but you have to understand when your ego is kicking in. You have to be able to say, that's my ego. That's not really me, because then you can manage it. You can start ego management. It'll never be ego elimination. It'll always be ego management. And I don't care how long you've been at it. I don't care how much you understand about the ego. I don't care how much you understand about how the brain physiology and anatomy actually works in regards to creating behavior and action. The reality is ego will short circuit all of that. And understand here real quick that there's two kinds of ego. There's the prideful, arrogant ego, and then there's nurturing and mothering ego. And the challenge with that side, the challenge with nurturing ego is it doesn't know its boundaries. And so while it's a mechanism that was designed there to protect you from some things, it can actually hurt you because it can kick in too hard. And if you're not aware, it becomes a challenge. If you're not aware, you become a victim. If you're not aware, you blame other people and circumstances and third-party events and people for your results rather than your ability to be accountable, take liability and responsibility for the results you generate. So ego is something very important. And when I talk about ego, for the most part, everybody here has pretty significant ego. And as I'm saying, it's not something that goes away. You have to attack it every day. You have to work on that ego awareness. If you have a good relationship, i.e., significant other, partner, wife, husband, whatever, you should be able to become accountability partners for that. You should have common goals and dreams and whys, at least at some levels. And you can ask your accountability partner to be bold and forward and let you know when your ego is kicking in. And then you have to be receptive to that. Don't let your ego get in the way and defend. Oh, that's not ego. No, if you've got an accountability partner, which is a great way to grow through ego challenges, somebody that's around you a lot. It has to be something. It's not just a good friend. It's not just somebody you talk to, now and then, even talk to once a day. They have to be around you a lot in order to be an accountability partner that can help you on ego. And so mastering ego management is probably the biggest part of the head game, in addition to understanding RAS and sensory information gateways. And once you start to be able to be ego aware, then you can start to manage your ego and have it work for you instead of against you. So things we will talk about, but it's also things that are required to be successful in trading. You must grow to have emotional intelligence. And, I think the bigger examples there have been around for a long time, way before the emotional intelligence books were written. And that is count to 10 or go to sleep on it, or however the wives' tales have been taught to you from the ages and from the wise people who have been around and passed on. How you respond to events in the heat of the moment is very important. And so emotional intelligence is something we're going to grow through, and we all need to continue growing there. So these are the good and the challenging / sad part of personal growth is it never ends. And you always need to be putting more and more effort into it. And we'll talk about understanding where you're okay and where you're weak in the various elements of things like emotional intelligence and ego management as we move forward and learn about some of the universal laws that literally dictate completely our lives. You must be driven by the trading math, not sales hype that you hope is real. So a lot of people go, oh, I'm not good at math. Well, we're talking about like math 8 here. We're not talking about sophisticated stuff. But you do have to understand math does drive it. So all that stuff that you were fighting in early high school, maybe even middle school, like, yeah, when will I ever use this again in life? Well, now's that time. And, as you understand some of the simple principles that are involved in trading math, you'll understand what drives your trading results. It's that simple. When I first started to trade, nobody was teaching that stuff. No, this is the system. Here's your stop loss trade. You win or lose. And nobody was saying how you could optimize. Well, if I'm winning at this percent, how can I, the way it was taught is if you wanted more money, you had to trade more often because this was your return, trade more money. And rather than saying, is there a way to make more efficiency? Is there a way I could be better and more productive with the actual trading I'm doing? And this is why the old paradigm is kind of like has brainwashed so many people, because they're just falling in line like the lemmings in the old IBM, Apple commercials, mocking IBM users or PC users, lemmings walking off the cliff because they're just, Stepford wives, whatever analogy or metaphor you want to look at, is just not even questioning what's going on, just absorbing it and moving forward. And so we have to stop sometimes and understand that there is simple math. And once you understand the simple math of trading, you can start honing in on, well, I'm wasting my time there, or, oh, look, I better put more emphasis here. And it's the only way you can do it, because that's the math is what impacts the results, right? And not have faith and belief in the sales hype a lot of people have been told. So lastly, kind of my motto on, moving forward and pushing failure away and staying with the journey until you find success is 3 different little quotes on that. Whatever It Takes comes from Grant Cardone. Persist Without Exception comes from Andy Andrews. And No Matter What actually comes from Lee Milteer. So you can just take those three different little quotes regarding pushing forward when you're hitting obstacles and make it a sentence, and that's a post-it note right there. Whatever it takes, persist without exception, no matter what. Uh, so with that, um, you know, we have a pretty good understanding of what it's going to take, and that's a screenshot worthy. Uh, that's a screenshot worthy piece of information. All those bullets, and you can start to look at and create your own gap map from where you are right now, if you do an honest evaluation, to where you need to be in order to become a successful trader. So I talked about reading some books as a beginning place. There's dozens and dozens of books I would recommend, and we will over time. But The Compound Effect by Darren Hardy and The Slight Edge by Jeff Olson, they come at that elephant from slightly different perspectives, but it's all about understanding compounding. And this is important for your learning curve. This is important for your financial gain curve. And again, no magic crystal ball, no holy grail, just the absolute truth transparently on the reality of compounding and the exponential curve. And so I use a page right out of Jeff Olson's book here to talk about that curve. And if we look at the top half, it's about what's uncomfortable early becomes comfortable later. What's uncomfortable early becomes comfortable later in regards to finances, health, business, personal development, relationships, right? And one of my favorite quotes of all times is, this thing about sacrifice. What's sacrifice have to do with it? Well, the quote is sacrifice for what you want, or what you want becomes the sacrifice. So we mentioned this briefly again in the bonus section. Everything that was mentioned in the bonus section, we will teach in depth over the next several months. But, what we're talking about there when we say sacrifice for what you want, it really is sacrifice now for what you want. That means sacrifice your wants and desires in the short term, where you're guided by emotion. So sacrifice for what you want. Do the things, pay the price. And as Brian Tracy says, you always pay the price in advance. So pay the price for what it is you want, or what you want becomes the sacrifice. And that's exactly what Olson is saying here. What's uncomfortable early becomes comfortable later. And you look at the downside where you spiral down, what's comfortable early becomes uncomfortable later. And again, you see those arrows get broader, thicker, and the angle of them, the slope of them gets more significant as time moves on. And that's just to where we see in the middle in that gray area, I call that the flat part of the curve. The flat part of the curve, because while you're making progress to the positive or to the negative, while you're progressing, you don't see it happening. It's just happening on its own in such small increments that you just don't see the difference. And then it's time, it's compounding of those micro changes to the positive or to the negative. It's compounding of that brings the arrow big and fat, and in a big positive way or a big negative way. And so everything you do matters, to quote Andy Andrews, everything you do matters. And so the reason we see, the 5% that are successful, they've had that incremental progressive realization of a worthy idea, and they've worked on it. And they aligned their principles, their priorities, and their values with their goals. Too many people have these big, ambitious goals. This is why New Year's resolutions don't work right here in front of you on this chart, because the goal, there's nothing wrong with the goal. It's not an impossible goal. It might be lofty, and so it doesn't mean it's impossible. The challenge is that being the goal, that being the dream, is one thing. They sit back and daydream, and that's what they want the big picture to deliver for them. The challenge is on a day to day basis, they have different priorities and different values than what dictates making that dream happen. And so when you put your emphasis on short term priorities and values, how you're going to be distracted today, as an example. What amount of time are you distracted? Oh, you went on to check that. You got a DM from somebody on Instagram, and the next thing you know, and you're rolling through Instagram Reels. Okay. And next thing you know, you're looking at your report on your phone about how much time, screen time you had the past week. And if you look at that and you go, holy cow, right? That's what distraction will do to you. But that's a priority, that's a value. And so you have to work on the goal process, which we will, in order to minimize the distractions, to keep. Here's the key: your priorities and values have to align with your goal. If your daily priorities and values aren't aligned with your goal is not going to happen. It's just that simple. It's what shortcuts the goal. And that's exactly what Olson is trying to talk about here, is to have responsibility, to have discipline, to be value driven. And on the downside, you're going to think entitlement. In other words, things are just supposed to happen for you because after all, you're you, right? And you'll blame, you'll neglect, you'll be a victim. Third parties are always the reason why you don't have certain things. You're just unaccountable and don't want to take responsibility and liability, therefore you don't put in the effort. But your short-term priorities and values have to be in alignment with your goals, or it's not going to work. So let's talk about risk and position sizing, and we'll go through this fast again. A lot of you have been around me for years, know this stuff. And I apologize for the repetition, but on the other hand, I don't apologize because repetition is the key. So I throw this out because this is where you need to be as a trader. I have $1,000 balance in my standard trading account. I'm going to use a 15 pip stop loss in my Euro USD trade, and I'm willing to risk 2% in that trade. The question is, how many lots should I enter into the trading station for the trade? So all of the data is there in order to be able to answer the question. And if you can't do this on your own, if you have to look at tables, or do the whole, 0.01 per 1,000, you probably still don't have the math to accurately do what you need to do. And so you need to be able to learn this. And so the formula is pretty simple. And what does it have to do with wedges? You can't trade wedges to make money unless you know how to position size. Otherwise, the technology that you gain on the technicals and the chartism aspects mean nothing because you're going to blow up because you don't have the financial understanding. So now we're coming down to some of that trading math stuff. So the formula is pretty simple. You take your account balance times the risk percentage you're willing to lose in a trade. You divide that by your stop loss times the value of a pip. And so if we look at that example that we had, I have a $1,000 account, 15 pip stop loss, value of a pip is $10, risk in trade is 2%. We just substitute those items. Those are the 4 items required. And we get 1,000 times 0.02 divided by 15 times 10, 20 over 150. The answer is 0.13 lots. Now we have a calculator we can look at here in a second, but let's go back and see that real quickly here. It said my standard account, and it specified the Euro USD. What that's going to do is it's going to allow us to understand what the value of a pip is for the Euro USD. Here we plugged in $10. That's just the norm. That's actually for USD based pairs. But what about other pairs? You trade other pairs. Do you not trade the pound yen? Sure you do. The value of a pip is not always $10 for all the pairs. So we have to go to something called a table. You can actually do the math yourself if you want to learn how to create the value of a pip. Right, there's tables that are updated in real time. This one's from investing.com. And as you could see, with the example with the Aussie USD, the standard lot, which we said we were trading, the value of a pip is $10. We could drop down to Euro pound. All of a sudden, the value of a pip is $12.37. We can continue down. The pound Kiwi, $6.01. So if you're always using $10 for the value of a pip in any pair you're trading, you're going to get different answers than what you were expecting, different results than what you were expecting. So it's important to understand the value of a pip as well. And again, this will be covered pretty adequately and thoroughly in our Quick Start Beginners program that we're working on right now. So we do have something. This calculator I will make available for you in the HighFX Traders group, where it pulls in the four things we just talked about. I'm trading a standard account, Euro USD. The value of a pip is $10. I have $1,000 in my balance. I'm willing to risk 2% in the trade. My stop loss is 15 pips, and bingo, I can trade 0.13 lots. So just proving the calculator does the same thing that our simple math could do. And to show you now some interesting things about your stop loss. So if you have technology which allows you to tighten your stop loss without increasing the risk of losing the trade, we could look at column 1 and column 2, and you'll notice they're pretty much exactly the same with one exception, and that is in column 1, my stop loss is 10, and in column 2, my stop loss is 15. Everything else remains the same. I have a $1,000 account. I'm going to put 2% risk into the trade, etc. And so when we can go and look then at gaining just 5 pips, one with the 10 pip stop loss, one with the 15 pip stop loss, we can see that with the 10 pip stop loss, same time frame, 24 months, trading 22 days a month, at the end of 2 years, that $1,000 is now $191,000. With my 15 pip stop loss, same trades, same downside risk, same starting $1,000 balance, using a 15 pip stop loss at the end of 2 years, my balance is $33,392. That's a difference of $157,000, $158,000 by being able to have a technology that gives me 5 extra pips or 5 less pips in my stop loss. So just having the ability to tighten my stop loss up brings me much significant more of a return, right? All right, so as we said, the stop loss, it's not there just in a trade gone wrong, which is where 99% of the market is going to teach you. That's what a stop loss is. The reality is the stop loss is your profit regulator in your trading. It's singularly determined, well, your skills and whatnot, but I'm talking about when you get down to the math of winning, your profit is determined by the size of your stop loss. So I need to remind you that as educators, the CFTC here in the United States, the Commodities and Futures Trading Commission, doesn't take kindly to educators who essentially are disguising what they're teaching as strategy selling. Okay, so we have to be careful. And so I remind you, we really cannot tell you where to enter, where to take profit, or where to exit in trades. That can often be seen as providing financial advice or trading advice, which is not our line of business. What we can do is show you how some other traders see wedges and how they trade them. We can talk about statistics that have been gathered by those that gather statistics over the years on wedge success in certain situations. And as you grow your time on charts and grow your overall skills, you will come to understand there are many ways to trade wedges. We're particularly going to get into that we're going to show you a standard way that you can trade, and then we're going to show you intermediate advanced ways to trade and to understand what's going on with price movement in and around your wedge. We also then can talk about, we have several money management opportunities to trade as applied to wedges. So you have various things that can be there to facilitate and actually change the degree of profitability in your trades. And so it's important to understand we can't say this is the way. Because if we say this is the way, then we're solution sellers and not educators. So we can point out the good, the bad, the ugly of certain things, including entries, including stop losses, including money management. But ultimately, as always, it's the trader's decision and the trader's choice what to do in that trading. So that being said, let's look at some things to consider when trading wedges. So we talked the other day in our reading how to read wedge plus trade alerts based on the information provided in the wedges. And we did talk and extended it a little on the education side to understanding that wedges are nothing but two trend lines that have an angle and contract at some point. And so it's very important to get that down and forget about the entity of the wedge. You have to understand you're essentially a wedge is these two trend lines, one at the top, and it may be pointing up, it might be pointing down, but it's still the top line. And I have a bottom line, which most of the time can be pointing up. It could be flat. It can be pointing down, but let's just talk about this example here. And so we have two trend lines, and the reality is what we talk about a wedge break is nothing more than a trend line being broken. And so wedges in that sense aren't anything special. However, there's a unique attribute that when you have two contracting trend lines, there are attributes about what happens. And again, this is just some of the woo-woo in charts in regards to people who have surveyed and journaled results from wedges and have some pretty good solid statistics, which we'll look at here probably tomorrow. So just understand that wedge trading is nothing more than trading a trend line. And so there's some attributes about trend lines we want to understand. There's a thing that we typically call a pack and check, which from a technical perspective in the trading realm is either a throwback or a pullback on a trend line. And so on the left, you can see we have a trend line that was acting as resistance, and price kept approaching it, and it kept being rejected by the trend line. Eventually, price was strong enough to break the trend line, but the trend line is like, you think you can escape, watch this, and it sucks price right back to it. And now we have the battle between the trend line and the price, and in these particular situations, price wins. It actually says, okay, you tried pulling me back, you pulled me back, but I still am stronger than you, so I'm going to leave you now. And this move after the throwback tends to be a very impulsive, strong move. And so very often what you'll see with wedges is I see traders miss these moves because very often this throwback comes on the trend line after the wedge. So the trend lines have crossed doesn't mean you still can't have a pullback, a throwback, or a pullback on that trend line. So pullback is the same thing, just in a bearish sense. The trend line is acting as support, and price comes down, here in the example again 3 times, trying to break that support. Finally, the 4th time it does, but it gets pulled back to the trend line. And both of these we call pack moves as for pass and check. So it's going to pass the trend line, it's going to come back and check it. Some people, in a synonymous, using synonyms, have called that a retest, a retest of that support and resistance line. So be aware of these moves. I can tell you in the realm of trend lines, these occur frequently, and the move after the pack move, after the pass and check, after the throwback, after the pullback, the move after that is pretty substantial, not only in percentage, but in pips gain. So they're very strong moves. And as I said, in wedges, we see it occur pretty frequently. So we're not going to go in depth to Elliott Wave. We do have a module coming up. After we get the first 3 or 4 bigger ones done that we want to get done, we're going to have a module on Elliott Wave as an introductory, just so you understand a little bit about market structure. We're not going to trade Elliott Wave per se. Those that are in our chart markup and chart setup group will see references to Elliott Wave, particularly on lower level, like 30-minute level charts now and then, not always, but sometimes frequently, just so you understand potential direction. We don't trade Elliott Wave. Those who have digressed, diverted, been distracted to the appeal of Elliott Wave because of things they've seen in the marketplace. It's a long time study, and it's an expenditure of energy and effort that may be put into better places in the trading realm. And most of the people I know that have skirted off to try and be hard students of Elliott Wave in the faith of, in the belief and faith in trying to trade it, or that's going to be successful in their trading. I just don't know anybody that's done it in 17 years. And there's a lot of reasons for that, and we'll talk about that when we talk about Elliott wave. But it's important to understand the structure. In the green on the left, we have sub-green waves, lighter green. There's three of them. Boom, the brown wave, another boom, green wave, a brown wave, and then boom, another green wave. And the important thing to understand is in those brown areas, those are called corrections, retraces, pullbacks, etc. And this is frequently where you will see wedges occur. It's in these corrective moves. Wedges can be considered corrections and, for the most part, continuation patterns. So mostly, as we'll learn tomorrow, a wedge continues in the direction from whence it came. And so, as you can see here, if there were wedges in those brown spaces and they occur at the end of each of those green runs, they serve as a continuation pattern for the price and the bigger wave to continue forward. So just understand that for the most part, triangles and wedges are corrective patterns and continuation patterns. There will be exceptions to that. We'll try and understand that. But for the most part, they are corrections, and that's where they fit in the Elliott wave realm. And tomorrow we'll look at a little bit of the structure of those waves themselves. So again, we're talking about trend lines, and in trading a trend line, we have to be careful about its strength. So for the most part, a trend line is technically defined as connecting 2 points. It's like connecting 2 dots, the wicks of the body, if that's all there is, on 2 candles that, when connected, create a trend line that's extended. And what we're illustrating here, and we covered in the reading of the Wedge Plus Trade Alert itself module, we talk about the potential danger of a trend line that is created by 2 points, and that is an RAS function, a sensory information gateway function, that once we see that second point and draw the trend line, we essentially become emotionally attached to that trend line, forgetting that we based it on point 2. And the challenge with the trend line is that while it connects 2 points, as we see here with 1 and 2, the reality is it can actually be, one of those points can actually be not quite right. In other words, it was the point to connect in real time. It was the low in real time, but as time moved forward, all of a sudden I have a lower low. So is point 3, that red candle that breaches the trend line, is that really a breach of the trend line, or is it just a better point to create a new trend line on, which we did with the dotted line? So when it comes to wedges, we have to be careful with this for trend lines that are built on two points. Is a breach really a breach, or is it really just trying to be a more accurate way of defining where that trend line is? And what we thought the second point just actually is a higher low. And so it becomes insignificant in the trend line that we would draw from 1 to 3. So we have to be careful with trend lines. And of course, we noted in the reading of Wedge Plus Trade Alerts, and if you haven't seen that module, you need to see that module. It's the link's been posted in the group. We give wedge strength to these things, and wedge strength is essentially the number of hits on a particular trend line. So if one of the trend lines given a 2, meaning it has 2 hits that created the trend line, you have to throw this cautionary understanding about what's going on. Now, if I have a trend line that has already 3 hits on it, there's 3 bounces, a breach after that, or a candle closing outside that trend line, having crossed it and closed, is most likely a breach. Okay, because we've established that line already with 3 points. So it doesn't mean it has to be, and that's why we say most likely. There are cases where it really is just a new trend line that's forming off one of these previous other points. It doesn't happen often. I'd say less than 5% of the time. Normally, when I have a 3-hit trend line and a candle breaches and closes beyond that trend line after that 3rd hit, it's almost always a breach, and therefore, in terms of a wedge or even a trend line, it becomes very tradable. Okay, 2-hit breaches, watch out. Now, in general, 3-hit trend lines are more reliable than 2-hit trend lines, except 2-hit trend lines where the 2 touches are from long isolated scouter wicks. Right? We talked about this in the reading alerts module. If you have 2 isolated scouter wicks, a scouter wick meaning it's the wick itself is as long, if not longer, than the body of the candle, and they're separated, and in other words, they're not right next to each other or one candle apart. There's some distance between them, and there are no other wicks of that size around them. That trend line is pretty strong. So when I have 2 scouter wicks still creating a trend line with just 2 points, those trend lines are that side of the wedge can be very strong. And in those situations, you will see us sometimes, instead of giving it a 2, we'll give it a 2 plus. It's still not a 3. It's still not a 3-hit trend line. But as 2-hit trend lines go, it's very strong because of those scouter wicks. The other areas where a 2-hit trend line can be strong is when they lay on top of existing proven potential support and resistance lines, such as a pitchfork. So if we have a wedge and we've already drawn a pitchfork and the wedge base or top sits with one, the upper parallel or the lower parallel of a pitchfork, that pitchfork is there for a reason. It has a high degree of bounceability because there's a high degree of Fibonacci-ness in it, because it's built on a swing which is defined by Fibonacci ratios. So pitchforks have their own strength, and when you have a triangle or wedge whose trend line lies on that, even a second hit is a much stronger. So it's typically going to be a 2 plus as well. It's not just a wedge. It's not just a trend line out in space. It's a trend line, that's determined in an independent way from a different technology. We're saying those 2 lines are equal. Sometimes we force that reality, and that's okay. And sometimes it just plops right there due to other things. So a 2-hit trend line of a wedge that falls on a pitchfork, or as I say, harmonic scans. So harmonic scans, typically, a 5 pattern, X, A, B, C, D. And when we connect elements of that harmonic pattern, like an AC line, while it's still only 2 hits, the A and the C are leveraged Fibonacci ratios that are part of a harmonic pattern. They are not normal swings because of that. Normally swings are Fibonacci based, but these are because there's what's the word I want to use? Consecutive Fibonacci sequences that create the harmonic pattern. Those 2 points, those 2 swings have a lot more bounce to them than just 2 points in space in terms of wick. So an AC line or a line drawn between the A swing and the C swing are much stronger than regular 2-hit trend lines. So there are those exceptions. When you have INS clusters, INS components with HPR's high probability reversal zones, where I have several support and resistance components that overlay each other. Let's say I have a value from a Fibo pivot and have a value from a Camarilla line, and they're lying on top of each other or within a pip or so of each other. And then I have 2 hits against that. Those 2 hits are a little stronger than 2 hits in space where we don't understand what's causing the hits. They're not scouter wicks. They're not part of a pitchfork. They're not part of a harmonic pattern, etc. The same thing with, instead of high probability reversals from 2 independent support and resistance systems which overlap, the same thing occurs with Fibonacci clusters, where I have 2 or 3 Fibonacci lines from different Fibonacci mechanisms. One might be a retracement, one might be a projection, one might be an extended retracement, and all of a sudden I see from those 3 kinds of Fibonacci's, they fall into a zone of 1, 2, 3 pips. We call that a Fibonacci cluster. When there's a Fibonacci cluster and I have 2 hits against that, again, that's much stronger than 2 hits I'll find anywhere else. So wrapping up today, What we're going to see tomorrow in Module 3 is we're going to look at the wedge patterns for those that have a understanding of trendline trading. A more intermediate and advanced technology is to understand the actual wave designs, because the wave designs inside a wedge can be predictive. Does that mean if we don't see the wedge pattern inside the wedge that it's not a wedge? Absolutely not. We've talked about the fact that when we can see these wave designs inside the wedge, it becomes predictive as to where it's going to break. It's either a 5-hit or a 3-hit wedge, and based on the pattern, we can tell whether it's a 3-hit or a 5-hit, and then we'll know where it's going to bounce. We know where it's going to break. In absence of being able to see those waves, it's still a tradable wedge, because again, what is a wedge? It's two trend lines that are contracting. And so I can have 2 hits, 3 hits, 4 hits on a trend line at the top and 2, 3 hits on a trend line on the bottom. It doesn't have to create any particular recognizable Elliott wave pattern. They are still contracting trend lines. But when we recognize patterns, we have an understanding with a high degree of accuracy, the predictive nature of then which is the last bounce that's going to force price to cross the other side and continue. So we'll look at those designs. We're not going to spend a lot of time on it in the beginning world. We may from time to time point out a wedge that has a specific pattern so you can see it as relative to the stuff that we'll present tomorrow in terms of Elliott wave defining what a wedge really looks like. We'll talk tomorrow about how wedges break, some simple targeting based on known statistics. We'll talk about where to put your stop losses for the most part, the options for that. Again, we can't tell you where to put it. We'll just talk about the options and what you might consider based on what other traders are doing. Coming up in the module after that, in module 4, we're going to have our introduction to HighFX33 as an indicator and harmonic wave convergence, and we'll get into intermediate and advanced trading with wedges, where we can actually get into those wedge trades before the break, typically on the opposing side of the wedge, the other bounce off the other trend line, and obviously by being able to get in on the opposite side, we extend the profit in the trade. Obviously, if the point of the break is bouncing off a trend line and it goes 4 or 5 pips, and then we would typically wait, depending on the depth of the trend line or the height of the trend line, we might wait 2, 3, 4 pips to have a candle close outside the wedge. And so if I'm going 4 pips across and another 4 pips to wait for a closed candle, and I could get in on that bounce instead of waiting for the break, I get an extra 8 pips in that trade. And let me tell you, I can show you mathematically where 1 pip more is hundreds of thousands of dollars. So if I can get 8 pips more in a trade, that's pretty slick. It also means what? It means I can really increase the strength I put into my trading criteria for taking a trade. I can start cutting out the weaker criterias and just stick with the absolute best. And so that's a cool mechanism, knowing I can get more inside the trade, more outside the trade, more inside the wedge, more outside the wedge. And it increases the probability because I'm taking higher criteria trades. Those are all great things, right? And so then we'll look at the technologies, as I mentioned. There's about 4 really solid money managements we can use in wedge trading. And we'll talk about how to extend those profits and optimize those profits in a safe manner without putting at risk what you've already earned. So good, fun stuff coming up in modules 3 and 4. And with that, still went over an hour, my bad, but it's not 2.5 hours. So with that, I'm going to shut this down. Hopefully you can make it back tomorrow for session 03. It's on your calendar, posted in the group. And again, I applaud your commitment for being here, regardless of whether it was the end of the day and it was easy for you to be here, or if you set your alarm for 2 o'clock in the morning to be here. Either way, you showed commitment to being here and to get that jump start on what this library will eventually offer you as a trader. So thank you for your attendance. And as always, I'm going to remind you that life can be short and sometimes even shorter than that. So for the people you care and love, let them know you care and love them. You all have a great day.